Hi guys, welcome to the part 2 of the video where we discuss an asset class, the most important asset class according to me, which is the stock market or equity, and we try to understand and learn it from by posing a broad question: is stock market gambling? Right. So in the part 1, I'll summarize that first. Is that we discussed about the idea of gambling. We discussed that uncertainty is not bad. Life is uncertain, right? And more importantly, we discussed the idea that what makes anything a gamble. When you work towards something without understanding its odds of winning, without trying to systematically improve your chances of winning, you're gambling. And that doesn't matter which area of life it is and what you are doing, it applies everywhere. All right. So with that said, let's go to the second part where we actually discuss about stock market basics. So I'll not go deep into any area. I want to give a very broad understanding of the stuff, and then we'll try to link the basics that we've learned about the stock market and the idea of gambling, and see, how can you improve your odds of winning in the stock market. All right. Uh, okay. So the first question: what are stocks or what are shares, right? uh, Essentially, stocks represent an ownership in a company. So think of a pizza store next to you, let's say any food joint near you. You can buy a stake in that company, you become a part owner, right? And when I say it's mostly passive, I mean that you don't actually run the company, you don't participate in the day-to-day activities of the company, but you have a stake in the company's profits, right? That's what broadly it means. Okay, so we understand what stock or a share is. The next question is, what is a stock market or a stock exchange? I think here the verbal and the literal meanings are same. Essentially, it means an online market or offline market for stocks, where you buy and sell them. So, before internet was there, most of the trading used to happen on trading floors and not trading desks. So essentially, there used to be people in pits, and they used to bid and ask about, I want to buy this at this price. Someone else is shouting, I want to sell this at this price, and eventually they will agree at a price and trade will happen. Now most of this stuff is online. Even you and I, as a retail investor, can log in, get a demat account, and start trading. Put in our orders electronically. So now this entire stuff is online, but the idea still remains the same, that an exchange will match orders between buyers and sellers, and a trade will happen, right? So that's what a market and exchange is. And the next logical question a lot of people ask is, okay, I know stock market, but when they say, okay, stock market has gone up and stock market has gone down, what do I actually mean by that? So what they are actually asking is, what is Nifty or Sensex from an Indian context, and what is S&P 500, if let's say from a US context. And there are markets everywhere. So there's DAX in Germany, there's FTSE in UK. So essentially there are indices in every nation, and then there are global indices as well. So what does this mean? So you can think of it like this: they essentially, at least the broad indices, what they mean is, you pick the top companies which are listed in the market that we discussed above, and you buy them in a proportion that you buy the bigger companies in a higher proportion and the smaller companies in a smaller proportion, and aggregate how that bunch or that basket of stocks perform. That represents the market, and this basket of securities or that portfolio, hypothetical of course, represents an index, right? The technical term for that, on how you buy, how much you buy and sell, is called free float market capitalization, but I'm not going to go deep because that is beyond the scope of basic video. All right, so we understand what are stocks and shares. We have a broad understanding of the stock market as such, and also what are the stock indices like Nifty, Sensex, or S&P 500. All right, so now let's ask the second question. How does one make money from stocks? right? So again, here we should start thinking of the way we have understood what a stock is, right? So how have we talked about it is a business that you own partly. So now you have to think on those lines, and how would you make money if you are a part owner of a business? Okay, the most common answer that I hear is salary. Can I make salary out of my business? Yes, of course, you can make salary out of your business. If you are working actively on it, then you can withdraw salaries. But we have already discussed that stocks in general, when as a retail investor you are trying to buy or sell, you have a passive ownership in the sense that you don't participate into the day-to-day activities and functions, right? So if you don't do that, you can't withdraw salaries, right? So we'll check that off. Okay. All right. So I can't draw salaries. What else can I do? Well, I am the owner of part owner of the company, so of course I should have some rights to the profits, right? That is the next answer. So let's assume you are owner of a, let's say, a pizza shop nearby your house, and you make let's say you sell a lot of pizzas. Your total revenue that you earn increase is more than the cost of making the pizza and the salaries that you are paying to the employees who are making the pizza. Out of that, whatever is left, that is your profit. Now, of those profit, you can do two things. The first thing is you can reinvest that profit and grow your business, right? You can buy, you can grow it into a chain, and you can do a lot of stuff with that. Or instead of reinvesting back into your business, you can, take that money out and pay all the owners of the business, right? So that is what is called dividends. All the non-reinvested profits are dividends, and there are a lot of companies which pay out dividends, that they don't want to reinvest all the profits that they have made, and that is one way to make money from stocks. What is the second way? All right, so I'm an owner. I can make money from the profits. What else can I do? I can sell, a company and make profit out of that. For example, let's say I owned two shops of pizza, right? And I can sell one of those shops. Let's say I, bought it for, let's say, $1,000. I mean, let's hypothetically take that as an example. I bought that shop for $1,000. I'm selling that business, or that part of the business, that shop, for $2,000. So I have made a capital gain. I have made a gain by selling that business, by selling that capital, right? So that is what is called capital gains. You have sold a stake in the company, probably, and hopefully at a higher price, to make capital gains. So these are the two ways. If you buy a stock, you can make money. So the next question is, what drives stock market returns? So there are two broad factors. One is fundamental, and one is driven by emotions. So let's talk about the first one. The first one is an actual growth in profits or revenues of the companies, right? So it's a market. The market has companies, and these companies show profits. They increase, their profits increase, their revenues or their sales increase over time, and that is what drives the returns in the markets. Now, how does that growth come in? Does that growth come in an hour or in a day? Of course not. Businesses are built over time, right? They are built in multiple years and sometimes even in generations, right? So that is factor number one. So what's the second factor? The second factor is the price that people are willing to pay for this growth, whether it is revenue growth or profits growth. What is the price that people are willing to pay for it? So if people are very optimistic at any point of time, they will be willing to pay a lot more, much higher price for the same amount of growth. And when they are pessimistic, or the entire group is pessimistic, they won't be willing to do that much. If they are scared, or there's fear in the market, people will withdraw money like anything, and that will can potentially crash the market temporarily. So how does that happen? That essentially happens, people's mind flicker every hour, right? And therefore you have volatility in the prices of stocks, right? So there is one factor which is gradual, which is fundamental, that is, you're betting on long-term growth of a company. And the second one is, very volatile, and you don't know what's going to happen next, because we don't know even our own behavior what's going to happen next. Forget about judging the entire sum of all emotions in trying to predict that. Okay, so now the question is, we understand what are the two broad drivers of the stock market returns, but how can we improve our odds of winning in these scenarios? So let's understand them in context of each one of those. So the first one, from the more fundamental point of view, is we need to increase our time horizon in a diversified portfolio of stocks. So what I mean by that, let's decipher it. By increasing the time horizon, what I mean is we know that companies don't grow in a day or two, right? Even Amazon, if you take as an example, it started, when the internet boom started in the late 1990s, and it took time to grow, and eventually now I think it is profitable. It has just touched profitability. I think AWS is very profitable. So it takes time. So you obviously also need to give it the time. You need to think yourself as an owner. You need to give time to the business for the business to grow, right? And the second point here, which I say, is a diversified portfolio of stocks. What I mean by that is, instead of betting on one company, one stock, you take ownership in a lot of companies, right? And then what is your bet? Your bet is on the aggregate of all the companies, running. So essentially, you're betting on capitalism in words of Morgan Housel. You're betting on the overall economy, because essentially if you take all the listed universe, they broadly reflect the economy on a 10-20 year horizon. Alright, so that was the first piece. And how do you deal with the other one? The people and the prices that people are willing to pay. So there are 2 points there. The first point is to have patience. And for us millennials, for youngsters who always want instant gratification, having patience is a difficult thing, because everybody else is doing this. I have fear of fear of losing out, missing out. Apologies. And the second one is, you need to survive extreme events. As I said, that there are times when people are very fearful. The economy is, economy might go down a few percentage points, but the stock market and the people, because out of the fear and the collective fear, it may go down 50-60%, right? So the first rule of stock market or any investment in this case is to survive. If you can't survive it, you can't thrive. So how do you survive? Is by holding cash. So in the first piece, I talked about diversification across stocks. So instead of buying one stock, you buy multiple stocks. In the second one, I'm talking from a survival point of view, and there I'm saying you not only buy stocks, you also hold some cash. By cash, I don't mean cash in your drawers. Any liquid instrument like a bank deposit or anything of those sorts, short-term government deposits, all those are classified under cash. So you need to diversify within equity, and also you need to diversify across asset classes by holding other instruments, right? So the purpose of cash is to survive. The purpose of stocks is to grow, right? You need to increase your time horizon and have patience. If you follow these four broadly, you can systematically improve by increasing your diversification to a certain extent, by increasing your time horizon, because even hedge fund managers or asset managers, they have a very short-term time horizon, because they need to report quarterly or monthly or annually. But you don't have to do that, right? You are a youngster. Let's say you're 25. Let's say you want to retire at 45 or 50. You still have 20 years, right? You have some that is more valuable asset that you have as a competitive advantage. Again, in words of Morgan Housel, you have it as a competitive advantage over others. So increase your time horizon, diversify across stocks, diversify across asset classes. As example, I gave you is cash, and be patient, right? This is how you can invest in a stock market and not gamble around it. With that said, bye-bye.